got William Lee, Chief Economist and Executive Director at Milken Institute, joining in from LA to talk about exactly what to expect from Jackson Hole. William, good to have you on the show. I have to start off by asking you about one of the most significant gatherings, right, in the financial world, Jackson Hole. The meeting is slated for later tonight. What's your expectation? Any specific comments from Powell, which could be a trigger for the global markets?
The financial markets are all waiting with bated breath to hear what Chair Powell has to say. And I think Chair Powell historically has really not given very many clues as to what the next policy move will be at the Federal Reserve. So I think if he comes out with a neutral statement, which is to say we're going to wait and see what the data tell us, I think that will be what I would expect, but that will certainly disappoint markets because they want to hear something about either it's going to be 2 more rate cuts or that maybe the Fed will be scared off by inflation. They want to hear one thing or the other, but I think Chair Powell will come out with a very neutral statement.
Right, William, while you talk about rate cuts and interest rate decisions, what are your expectations from Fed meeting in September? Will 75 basis points rate cut for the rest of this calendar year be too ambitious to ask for?
That would be a very ambitious thing to have. All the years that I spent as chief economist at the Citigroup, when I talk to clients, I differentiate. I said, this is what I would do if I were on the board, but that's not what I expect the board to be doing. If I were on the board, I would be cutting 50 basis points right now and maybe another 25 basis points later on in the year. But given the uncertainties about inflation and whether the tariffs will have some kind of a downward effect on growth, the Fed is going to be very, very cautious. And so if I were to say what I expect the Fed to do, it's very different. I think they will be very cautious. And at best, they will have a 25 basis point cut in September if the inflation numbers in September come in very, very calm and if growth starts to fall off, especially in the labor market.
Since you spoke about tariff, wanted to scratch that point further. Do you expect hefty tariffs by the US to weigh heavy on inflation numbers going forward?
No, and unlike many economists, I do not expect the tariffs to have a very dramatic impact on inflation. Maybe in the next quarter or two, it'll go up, it'll raise the CPI by a quarter point or half a point, but that should fade fairly quickly once the new prices are established, if they are established. Because you have to remember, the U.S. is a very closed economy. Consumption is 70% of GDP, and of the consumption basket, 70% of that is domestic services. The goods that are consumed by Americans, only about 25 or 30% are produced abroad. So when you see how much impact tariffs have, it's really on a very, very small base of goods. And many of these goods, may raise the price of, say, washing machines and dryers by, say, a percentage point. But how often do you go buy a washer dryer? Hardly ever. So for as far as the impact on most Americans' lives, it'll come in the form of things that they like to have, that they are used to having from abroad, like tequila or avocados for the guacamole dip. And when prices go up on these things, consumers tend to substitute something else. They tend to go for something cheaper. Instead of guacamole dip, they'll serve hummus.
Interesting take there. But lots happening, Lee, when it comes to the geopolitical front as well. After Trump's meeting with Putin last week and with Zelensky earlier this week, how is it that you're assessing the geopolitical landscape? And more importantly, what impact do you think it's going to have on global oil markets?
Oh, that's a fantastic question. Right now, the oil market really has not reacted at all. Brent is still well under $70, and it borders on $65 a barrel. And I think what we'll have to consider would be how these geopolitical risks are going to be evolving. The talks are very, very difficult to forecast, and I think most of the corporate world is really not paying that much attention to those considerations, because I think there's a tremendous faith that the negotiations will either lead to the war continuing as is or will make things better. So in that sense, geopolitical risks will likely not get worse. The only expectation that people have right now, especially for India, would be what India's policies will be regarding its imports of oil from Russia. And I think that's a big question that is yet to be resolved.
That's right, William. We all are eager and keeping an eye on what will be the trade negotiations and deals with India in particular. But moving ahead, central banks across the globe are at different points of monetary policy cycle. What are the key risks market need to be cognizant of while assessing the global policy action?
Well, central banks around the world, have very different tasks. Many of them are facing the prospect of a slowdown because of the uncertainties around global trade. So the tendency there would be for easing. But at the same time, it's uncertain how the supply chains will be disrupted. So what that does to overall inflation around the world is highly uncertain. So we're stuck in this very uncertain world where many countries will have a priority for making sure that inflation stays within their target. That's the case of the ECB, for example, that has a very strict inflation targeting regime, and they will keep rates higher than usual because of this uncertainty regarding how supply chains will be disrupted. Right now, there are pockets of inflation around the world, and for India, India is really going to have to resolve much more of its development strategy and its supply side, because that is really the future of where inflation is going to be going. India has announced just recently the Develop India 2047 plan to make India into a developed economy 100 years after its independence. That's a fantastic, fantastically ambitious goal. And part of the strategy, the most important part of the strategy, is to attract foreign investments and develop the resources that India has in so much abundance. And doing that is going to be the trick to keeping inflation contained and increasing income as fast as possible. And India seems to be on track for doing that because it seems to be negotiating with the global south, the BRICS countries, as well as the major developed economies as well. That's a very fine line and a very difficult line to toe. And it's going to have very effective conversations with all sides.
That's Viksit Bharat 2047 government's vision that you were just talking about. But let's talk about dollar as well. With dollar index now at that 98 odd mark, what's your view on dollar and the dominance of dollar with the changing world order?
Right now, the dollar still is the world's reserve currency. And even though there are efforts by the BRIC countries to come up with some alternatives, it's certainly going to be less efficient than using the dollar, at least the way the financial systems are now and the way global trade is done now, because the dollar is used as the numeraire currency, the invoicing currency for almost all of trade. But the strength of the dollar has really been sustained, even though it's come off its February peak by about, say 10%. It's well above where it was 3 to 5 years ago. And as long as U.S. exceptionalism, as long as U.S. remains the center for attracting capital, as long as it remains the center for innovation, global investors are going to want to invest in the United States, and that will continue the demand for dollars.
Lee, thank you so much for your time today. Great to be speaking with you. Okay, let's move on. Let's take a very quick break on that note. We are holding our okay for the equity markets. No